Right, welcome to our session today, ladies and gentlemen. Right, today I want to also talk about PPE and probably talk about fair value measurement. I also talk about fair value measurement, but I will not talk much about it. I think I'll talk much about it sometime next week because I think for some time. Uh, I will be having additional lessons with you because we want to make sure that we cover up, we can be ahead. So for some time, please, I'll be having additional lessons with you. That means we'll be having the normal Tuesday class, and on top of that, I will add a class, not double like this weekend, but just one class during the weekends, which I will just do maybe for 1 hour to 1.5 hours, so that we can be able to cover up. Because I want us to make sure that if it can be possible, we can be ahead of the schedule. So going forward, we are likely to have double classes every week. It's likely to be a norm for some time. I think maybe up to June, July. Then after that, we can then relax and come back to our one class per week. Right. So I will dwell much on value measurement either on Tuesday or on during the weekend. I will see what I will do there. Right, because I also want to also cover the other topics. They're coming hard and fast, which needs to be dealt with for the next assignment. Right, and also before I proceed, remember we said that on deferred tax there are two ways that you can be asked. They can either ask you to calculate the deferred tax. If they say calculate the deferred tax, then you have to answer it in the way that we did. This was the calculation of deferred tax. But instead of asking you to calculate the deferred tax, they can ask you to disclose the notes, the deferred tax note. Now, a deferred tax note is just a summary of what we have done here. So if they ask you to do a deferred tax note at the end of the day, you still have to calculate the carrying amounts and the tax basis of the assets. Right. But then when you do the note, you won't present it in the way that is shown above. So instead, let's do an extract of the notes, the financial statements of, what is the name of that company again? Cape Cafe Limited for the year ended 30 June 2018. Right. Then we'll have deferred tax. Then we'll have analysis of temporary difference. Right. We'll have our revaluation of land. Right. So you will have calculated this carrying amount and the tax base in the same way that we did, but this one will be given. So just say 950 minus 780. Remember, on the land, we said we multiply by 80% because of the capital gains times 28%. Right. Then you will have your this one here. Then we'll have accelerated tax allowance. building. Right. So you'll be taking from here. So it will be this one here. 1,198.36. You'll have calculated on your PP and the 1008. %. We already calculated it. Then we have got our fair value. Adjustment. Length. That would be this one here. And remember, we calculated this length and we didn't calculate, they were given. So that would be 1,410,000 minus 1,100,000.
Sorry, Mr. Eugene.
Yes.
Are we calculating the deferred tax note?
No, we're not calculating what is closing the deferred tax.
Oh.
Remember, to calculate, we already calculated yesterday. But I said they can either ask you to calculate or to disclose it. So this one I'm showing you if they'd asked to disclose. The calculation, the deferred tax, we already did it yesterday. Here is the calculation, it was already done. But I was saying that in this question, they asked you to calculate. But they can also ask you, instead of calculating, they can ask you to disclose the income, the deferred tax note. So what I'm doing now is the disclosing. If they ask you to disclose, that's how you disclose.
All right.
So when they say disclose, you do it in the way that I'm doing today. When they say calculate, you do it in this way. So if they say disclose, you won't need these columns here. You just have to calculate your carrying amount, calculate your tax base. You still have to do it. After calculating now, you present in the way that I'm doing now. Right. Then we'll have your fair value adjustments. So, but you still need to calculate your what? Your all your carrying amounts and all your tax bases. You still need to calculate them. Right. So here our fair value adjustment for the building would say we'll take the difference, but that one you have calculated already. Your like these ones will not have been calculated. I think they are on the question paper. You take this calculation here, which we used here. No, I think you okay. Sorry about that. We'll take the 1.660 minus, is it 1.4? 1.4 the cost. Times 80% times 28%. What do we get? This one I think we didn't have this week. Okay, this one we had it. So we're just taking these things that we did, just presenting them in a different way. Right? What do we get here? I think this figure we didn't have it. Remember, the fair value adjustment is the value about over and above or what? 58,240. Then we have got accelerated building allowance. then that will be the 1,400,000. Alternatively, you can just join them and just say a fair value adjustment and then just include the whole calculation. Remember that for the investment property building, it was made up of two parts. So these are the two parts that I've separated. This first part, which was the carrying amount minus cost, that's the one that I've already shown. Then we've got the second one, the cost minus the check space, which is the 1.4 minus 1,260. So we would say 1,260. Remember that we said the temporary difference before cost price is at 28%. What do we get? $39,200. Right. Then we have the kitchen oven. It had 65 and 86. Kitchen oven. Allowances. You can say 86. 687 minus 65,000 times 28%. Please, guys, as I said, these two you can join them. You can just say fair value adjustment, then you put the whole calculation like what we did when you calculate the deferred tax. That can also be possible. The kitchen oven was not negative, it was positive. It was a deferred tax asset. Then accelerated tax allowances. On the delivered vehicle. Which is 134,000 minus 125,417. This one is multiplied by 28%. Remember that as long as there's no revaluation, it's just 28%. So it's just exactly like our notes, our calculation, but it's only presented in a different way. So it's actually a summary of the calculation. Right, so this is how we prepare if they say prepare the note. Then if they say calculate deferred tax, you present it in this way. This is calculate. This is prepare the note on deferred tax. So both ways, you still have to calculate your carrying amount and calculate your tax base. Any questions? Okay. If you don't have questions, then I will move on to the document that I have today. Right. Today I want to look at briefly. I'll just talk about fair value briefly. Right. There are some standards that require an asset to be measured at fair value. Like I think we talked about investment property, and we earlier on, I think in our earlier classes, we talked about financial instruments, where we saw that a asset can be measured at fair value. Right. If there's a requirement to measure assets at fair value, we can apply the provisions of IFRS 13 in determining the fair value. All right. What is fair value? For an asset, is the price that you can receive when you are selling the asset. That is, if you have to sell your asset today, how much can you sell it? If it's a liability, how much can you relieve yourself of that debt at the moment? That's the fair value. And it should be a value between market, what we call market participants. And these people should be knowledgeable. So it's not a deal whereby you know that this person does not know and you just charge him 1 million on something that you know that it's 200,000. We're saying we're talking about knowledgeable people who know the circumstances that are on the market. And it should be in an orderly transaction. Right. Now, the fair value is determined because there are different markets. The other question can be, which market can you use? Because remember that you can buy a machine that we have as an organization. You can buy it from Joburg, you can buy it from Pretoria, you can buy it from Mpumalanga. So which market can we use? Because it has to be a transaction between market participants. So which market participants are you talking about? Right. We have got what we call the principal market. So if there is a principal market, we we have to use the fair value in the principal market. We have to use the fair value in the principal market. What is the principal market? The principal market is the market in which most of the transactions take place. For example, I'll illustrate it through this question here, question 2. Right. On the 31st of December year end, Marshall Limited, a manufacturing company listed on the Johannesburg Securities Exchange, decided to revalue its machinery for the first time. The machinery can be sold in two different markets, market A and market B. Marshall Limited has access to both markets. The following information in respect of the market is provided. Identify the principal market and the most advantageous market. Right. When we are valuing an asset, we either use the principal market or we use the most advantageous market where the principal market is not available. Right. But normally we use the principal market. What is the principal market? The principal market is the market in which a large number of transactions take place. So we look at the number of transactions, right? If you see the number of transactions here, number of transactions, in market A, we have 400. In market B, we have 200. So our principal market is market A. Is that right? So we can say let me just write a few things here. Value measurements. And property, plant and equipment. Right. So we're saying a fair value is the price that would be received for selling an asset. or paid to transfer a liability. That is relieving yourself of the liability in an orderly transaction between market participants. At the measurement date. That is the date that you are determining the measurement. It's year end, that means at your end, year end. Right. Fair value is determined in the principal market where such a market exists. But if the principal market is not identifiable, maybe if there's lack of clarity, you can't tell which one is the main market, is the markets are almost the same, and whoever dominates at any particular point in time, there are changes that are always changing. The most advantageous market is that right? The principal market is the market in which most of the transactions take place. So it's a question of the volume of transactions. Then the most advantageous market is the market right, the market that derives the best benefit after taking into account the transaction and all other direct force. Right. So we'll have to check, can we be able to identify the principal market? And if we are not able to identify it, we should use our most advantageous market. So now if I try to answer question 2 here, we can say the principal market is market A, as it has the highest number of transactions. Right. Any questions on the principal market? Okay, then we go to the next one. Then it says and the most advantageous market. And the most advantageous market. Right. Now, if we're determining the advantageous market, we have to find that what do you mean when you say what calculation they want? There's no calculation. You're just checking on the principal. You're just checking which one is higher only. So my market A is higher because it has got 400 transactions. You're not going to calculate anything. You just have to check which market has got the highest number of transactions. I don't understand your question. What are you asking there? Maybe can you please clarify your question? I don't understand it. On the principal market, there's no calculation at all. We are just saying that the market A is the principal market, no calculation. You just have to check which one has got the highest number of transactions. That's it.
Eugene?
Yes.
I think the reason why they're asking is that on the requirement, it says, please note all calculations must be shown.
That's what I'm answering. That on the principal market, there's no calculation. That's what I'm saying. Say.
Okay.
You don't calculate anything. You just have to identify the market that has got the highest number of transactions. That's it. So when you're determining your principal market, it's just checking which market has got the highest number of transactions. That's it. No calculation, no what. Right. Then the second part of the question says most advantageous market. On the most advantageous market, you check the one that has got the best benefit. That is, they can sell this machine at, if you can say, the transaction is 350 or 400, then there's transport and the transaction cost 11,500 and 11,000. Right. So what you do to find the greatest advantage, you find the amount that you can sell less the costs. Market A, market B. Right. Now, average cost, we have got 350,000 and 400,000. But for you to get that amount, there is also average transport and transaction costs. The net that you get here would be right. The most advantageous market is market B with higher net benefit. So if we don't have a principal market, then we would turn to market B, which has got the highest, greatest benefit, the greater benefit. That would be the most advantageous market. Is that fine? Right. So that would be our most advantageous market. So you would find that your most advantageous market is the market that will maximize what you will receive for selling the asset, or if it is a liability, you look at the minimum. If you are dealing with the fair value of a liability, you look the most advantageous will be the one that minimizes the amount that you have to pay. Right. I think you learned that these transaction costs are not subtract when determining fair value. We don't subtract transaction costs, but transport can be subtracted. I think it is on the first question that I'm going to deal with. Right. Question 1. The financial director of Laduma is unsure how to determine the fair value of the following delivery vehicle at year end on 31 August 2017. On 1 September 2016, Laduma Limited bought the delivery vehicle at a cost of 950,000 and incurred cost of 50,000 to modify the interior of the delivery vehicle according to the Laduma's limited transport needs. On this date, the delivery vehicle was available for use as intended by management. The delivery vehicle is depreciated according to the straight line method over its useful life for 5 years, which is similar to the rate allowed by the SA Revenue Service. At year end, on 31 August 2017, an identical delivery vehicle can be obtained at a cost of 1,020,000 and modified at a cost of 54,600. These prices are directly observable in the market. Right. We have got what we call levels of determining the fair value. Right. We've got level 1 inputs, level 2 inputs, and then level 3 inputs, which we call the fair value hierarchy. So when you are determining a fair value, first of all, you have to use the level 1 inputs. The level 1 inputs are quoted prices. If someone says an asset has got a market for similar assets that are in the same condition, whereby we can be able to identify the quoted prices on that market, those are what we call level 1 inputs. So those are the ones that we normally use if they are available. But if not available, then we tend to level 2 inputs. Level 2 inputs, these are not quoted prices, but can be observable from the market directly or indirectly. Is that right? For example, maybe we don't have such assets, but we've got a similar asset that has got a price on the market. Is that right? Or maybe we can also have prices in markets that are not currently active. Right. Then the level 3 inputs, if we don't have a observable inputs, then we use inputs that are not that are unobservable. So you can only use level 3 inputs if we don't have level 1 and level 2. Let's say you've got an old model of a motor vehicle that you don't even have a market for that asset at the moment. There is no market, and there's no way even in auction where they are selling such type of cars. Then you can use the level 3 inputs. Now if in this case, if they are saying directly observable, that means they are either in level 1 or level 2. Is that right? Level 1, that means it's exactly the same asset in the same situation, or exactly the same liability under the same terms. You can determine its market value. Then if they are a level 2, it can be directly observable, but not necessarily directly to a similar asset, to an exact asset. Right. So number 1, identify the fair value technique that is being used. Right. There are 3 fair value techniques that we can use when we're determining the fair value measurement, right? Valuation techniques. We've got three valuation techniques that we can use. Right, we've got what we call the cost approach. With the cost approach, when we're determining a fair value, the value reflects the amount that would be required currently to replace the service capacity of an asset. So when I look using a cost approach, we are looking at to how much can I buy a similar asset now? At how much can I buy a similar asset now in exactly the same condition? That's what we mean when we say the cost the cost approach. Then we've got what we call the income approach. Right. This values the asset in terms of the fair value, in terms of the present value that can be derived from the asset. So that means if we use the assets, the benefits that we're going to earn in future, what is their present value? What is the present value of all those benefits that we're going to earn in future when we are utilizing that asset? Then we've got market approach. Right. This uses prices that can be obtained by market transactions involving identical assets or liabilities. So you'd find that the main difference between 1 and 3 is that this one is mainly from a selling point of view. So if you've got the difference between cost and market, with the cost approach, you're looking at how much can I buy a similar asset in the same condition on the market. Then the market approach is how much can I sell a similar asset. Remember that normally when you want to sell something, the selling price is usually lower than the cost price that you can buy that item in the same market. So the cost approach is from a cost point of view. So now if you can see, this question is talking about at the end, they've got an identical delivery can be obtained at a cost. So they are looking at the cost of a similar asset. So we can safely say that they are using the cost valuation technique. So we can say the cost valuation technique is used as value is being determined on the basis of costs that can be incurred by a similar asset. So that's the cost approach. So cost approach, that's when we are trying to acquire a similar asset. Is that right? But if they were looking at the selling price, how much they can sell the asset, like if you saw the other question that we're looking at, it was the what? The market approach. So when you look at how much can I go and buy the asset, that's the market approach. The market, how much can I go and sell? Sorry, how much can I go and sell? But if you're looking at how much can I buy, that's the what? The cost approach. You're looking at the cost that you can obtain the asset. Any questions? Right. Then calculate the fair value of this delivery a vehicle at the end using the fair value technique. So this technique, it will look at the costs. That is 1,020,000 plus 54,600. What do we get? I think it's 1,074,600. That would be the cost of that asset. So that would be taken as the fair value. So you look at how much can I buy and make my asset ready to be in the same condition as the one that I'm trying to value. All those total costs, that's the cost approach. Any questions? Right. And please, if they, like in this question, if they'd given us transaction costs, you don't subtract transaction cost when determining fair value. Of course, when we are determining the most advantageous market, we subtract. We can subtract the transaction cost. But when we are determining fair value, transaction costs are not subtracted according to the standard. Transaction costs are not subtracted. Transaction costs, we're talking about maybe, let's say you are buying through a broker, then you are paying a commission. Maybe you are buying through someone whom you are paying commission. Such costs will not be included. We call them transaction costs. Transaction costs are not deducted when determining fair value. But when determining most advantageous market, you subtract them. So you should be very careful there. Right, any question? Right, as I said, I will cover the fair value in detail. I think I will see either, because I think I will see either on Tuesday or the other week, I will tell you. Right. Now the question 3. Remember that I said, and before I forget, guys, I think you should remember that I'm mainly concentrating on this topic because those are the ones that were not done properly. But otherwise, your tests, according to what they said, it can even examine the topics that we've already done. So you can even face what we've already done, like the leases, financial instruments, the income tax, conceptual framework, all those things that we've done. Right. Now, Veranda Limited is a large farming enterprise located in Mokopane, South Africa. Veranda Limited is the largest producer of tomatoes, beetroot, and cabbages in the Southern African region. The company is listed in the Johannesburg Stock Exchange and is a 31 December year end. The following information relates to the assets of Veranda Limited. We have property, plant, and equipment note. The interim bookkeeper of Veranda Limited presented you with the following property, plant and equipment note to the annual financial statements of Veranda Limited for the year ended 31 December 2021. The carrying amount, cost, and accumulated depreciation amounts included in the note at the beginning of the year was agreed to the closing amounts incurred in the annual financial statements for the year ended 31 December 2020. Right, if you still remember, I said you can be asked to prepare the PPE note, or you can be given the PPE note. Now, in this case, the PPE note is given. You don't have to prepare. You simply have to comment to see if it was prepared properly. Right. Our year end is December. Let's go to the required. Critically discuss with the reasons whether the property plan and equipment note was correctly prepared by the interim bookkeeper of Veranda for the financial year. Limit your discussion to the initial measurement, subsequent measurement, derecognition, and disclosure requirements for each class of asset. Discuss both correct and incorrect aspects of the accounting treatment of disclosure requirements. Right, so you should be very careful. It's not about just checking the ones that are wrong. We are concentrating on both that the things that are correct and the things that are wrong. Support all your incorrect aspects of the accounting treatment and disclosure requirements identified in the note with the correct accounting treatment or disclosure requirements. Do not include calculations in your discussion, so there will be no calculation here. Do not discuss the casting and cross casting of the property plant equipment. So don't worry about the adding up in subtraction. It's not an issue. Right. Let's start. All right, there is the property plan and equipment. The intended bookkeeper also provided with the following additional information. Then the land was depreciated using the building's estimated useful life and residual value and depreciation concerned from 30 September. The following calculations were provided. So they are the calculations that we have of the building, of the land. Let's go and check the information about that land. This is the land. Property in Mohopong. A Veranda Limited acquired property on 1 June 2019 at a cost of price of 10,750,000. Land 6 million, building 4,750,000. Right. Question 3. When you approach such a question, I want you to see this required. Limit your discussion to initial measurement, subsequent measurement, derecognition, and disclosure requirements. Those are the 4 aspects that we need to cover for each and every asset. Those are the 4 aspects that we need to cover for each and every asset. Right. So now let's start with our land. So you can do you can answer like this. You can say number 1, for example, land. Then under the land, you can do your subheadings, initial measurement. Initial measurement, we mean when you buy it, at what value are you going to include the asset? Right. So that's what we call initial measurement. That means when you buy the asset, at what value did you record it? Right. Right. So now this land, and another thing we need to read did they give us the policies? No, let's read them. They said that the Veranda Limited acquired a property on 1 June 2019 at a cost of 10,750. That is land 6 million, building 4,750 in Mokopong. Management considers the land portion of the property to be significant in relation to the total property. Right. The moment they consider it to be significant, that means it should be treated as a separate asset. It should be treated as a separate asset. Right. Right. Then they said managers, then they said during June 2019, Veranda Limited paid an additional 250,000 in cash to customize the building and to ensure that it complies with set standards for good agricultural practice. Right. The building was available for use as intended by management on 30 June 2019. But Veranda Limited only took occupation of the building on 30 September 2019. The building was estimated to have a useful life of 20 years and residual value of 500,000. So we're already reading the things about the land. Then on 31 December 2021, an independent sworn appraiser appointed by Veranda Limited determined the fair value of the land to be 7.5. The carrying amount of the land did not differ materially from its fair value on 31 December 2019 and 31 December 2020. Right. Let me see if they gave us the policies. Was your policies may so I think I left out. Can I just maybe let me quickly send you the policies that were related to this question. I think there were things that were unnecessary which I didn't want you to have. Let me just quickly make sure that I send you the policies that regard this question just very quickly. Sorry, just give me a few seconds. So that you can be able to get the policies. I'm going to send you via WhatsApp now. Right. Right, I think I'm sending the adjusted document. I just adjusted it now. Right. Have you received the document? Can we confirm, please, receipt of the document?
Not yet.
Not yet.
Received it, sir.
Is it received?
Yes, sir.
Okay, thank you. Right. There's a section that I just added, the part that had been left out. Right. Right, I'll go back now to the question. Remember, for you to know how to treat an asset, or when you are recording it, you have to know the accounting policy, because there are different ways that can be used. Right, now let's read the policy according to land. Right, owner occupied land is accounted for using the revaluation model. It is the policy of the company to realize any revaluation surplus upon disposal of the underlying assets to retained earnings. It is company policy that revaluations will be made with sufficient regularity to ensure that the carrying amount do not differ materially from which would be determined using the fair values at the end of the reporting period. Right, number one, we have to talk about the initial cost. Right, if we can see here, this land, remember that we're reporting under 3 headings. Initial measurement, 4 headings actually. Initial cost was 6 million. So initially it was measured at 6 million. which is correct. Right. So we're saying the land was initially correctly recorded as cost. Remember, no calculations. Subsequent measurements. Right. Subsequently, we know that they are now supposed to use the policy. And the policy, we've been told that it is to use the revaluation model. So they are now using the revaluation model. Right. And there is no way that they are talking about the depreciation of the land. Is that right? And we're told that this guy who did this note, he actually used the useful life of the building to depreciate the land. Right. So we can say, considering that, or we can say land is considered they said our land is considered a significant portion of property. Therefore, it's accounted for separately. From the what? The building. The land, the policy regarding land does not provide for depreciation. Hence, depreciation was not supposed to be provided. To be provided on the what? On the land. As you can see on our note, that this guy, although the policy was just to revalue, he just took into account the depreciation there. Right.
So, Mr. Eugene, basically here we are auditing.
No, something like that. Instead of asking you to prepare, you are just checking if everything was prepared correctly. So it's just like auditing, so sort of. Right. Then you would say that also that the accountant correctly revalued perform the revaluation of the land. So the amounts were wrong. Due to the depreciation provision that we mentioned above. Right. So remember that here he went on and he did the revaluation here. Right. Which was okay. But because of the wrong amounts, in fact, actually the revaluation was correct. Sorry, the revaluation was correct. I shouldn't even put, because it was 7.5 minus 6 million. The account correctly performed the revaluation of the land. So let me just remove this part, because he actually uses the correct amount according to the policy. If you can see, this land had a cost of 6 million and it was revalued to 7.5. So the revaluation was 7.5 minus 6 million, which is 1.5, which is what he did here. So the revaluation is correct. Is that right? We'll not talk about this depreciation. We've already talked about the provision of depreciation, that it is wrong. Right. Then another thing, on the land, we don't have derecognition. Derecognition will only be there if you sell an asset or derecognize an asset. So we don't have derecognition, but we have disclosure. Remember that if your land is revalued, you are supposed to disclose in the notes the fact that it was revalued and the qualification of the person who revalued the land. And also you should also disclose what could have been the value if the cost model had been used. So you can now go to the disclosure requirements. The note did not disclose the fact that the land was revalued. The qualifications of the revaluer, the carrying amount, if the cost model had been applied. Remember that if you are using the revaluation model and you revalue your building, we are supposed to disclose in the notes if the land and buildings were revalued by an independent sworn appraiser. And if not, you are supposed to state why. Then also you are supposed to state what could have been the carrying amount if you had applied the cost model. Any questions there? Right. Right. Next. I can't hear you when you say derecognition. We must what? Right. Then the next one, we go to building. Before we record the building, let's go to the policy. Owner-occupied building equipment and structures are accounted for in accordance with the cost model. A depreciation on the buildings and the equipment is provided for in accordance with the straight line method on the estimated useful life. Derecognition is just selling. You can even dump an asset. It's an old asset, you no longer need it. Then you dump it. That's derecognition. You have to remove it from the books. You do recognize it. So when you no longer, maybe the asset is no longer available for use and you maybe you throw it away or you dispose it, you have to derecognize it. You remove it from the books at carrying amount. Actually, we did derecognition yesterday when we were talking about that asset that was sold. When I was saying that you remove it at its carrying amount, that's a part of derecognition. We are not even supposed to provide for depreciation. Someone is asking about, don't look at the fact that the carrying amount at the beginning is below the cost. They are not even supposed to they said that assume that the addition and stuff like that is done correctly. The issue is the wrong thing was the depreciation. No, that one is not an issue. Don't worry about that. You can to put this carrying amount here, it's not an issue. You can start like this and then you put your carrying amount there. It's not even an issue. Right. So let's go. So the building is using the straight line method. Let's go and read about the building. Right, this building, remember, it was sold bought for 750. Right, and then there was an additional 250 to customize the building. Remember that all direct costs that are necessary to ensure that the asset can be available for use are added to the cost of the asset. Right, so let's look at the initial measurement. That did they measure this building at 4,750,000 plus 250, which is 5 million? Did they measure this building at 5 million? Then you find that they only measured it at 4,750. So you can have our number 2 building. Initial measurement. Right. The initial cost for the building was wrong, as it only included the purchase price and excluded customization costs. All direct costs to ensure that the asset is available for use. Should be included in the cost of the asset. So that means when you buy an asset, you are supposed to include all costs that are directly attributable to the acquisition. If you still remember, we talked about a transport, for example. If you pay transport costs, they're supposed to be added. Installation, like this customization, when they say customization, when you are customizing, you are putting the asset in a way that it can be usable to you. So in this particular case, it was a necessary cost to make the asset available. So these guys, by not taking that into account, that was wrong. They should have added. So the cost was supposed to be to include the 250,000. Any questions on that one? Right. Next, we look at the calculation of this depreciation. Is that right? Right. So we have this depreciation and we have this depreciation. Right. So we can also say that subsequent measurements. Depreciation was provided, which was in accordance with the policy. So that was the correct part. Then we can say depreciation wrong calculations were wrong, as they used the wrong cost. So you can see that continuously they were using the cost without including the that 250 customization cost. Right. Then we have to check the other parameters. The 4750, we said it's wrong. We have commented on that. The 20, was it the correct useful life? Right. The building was available for use as intended by management on 30 June, but Veranda Limited only took occupation of the building on 30 September. The building was estimated to have a useful life of 20 years and a residual value of 25,500,000. So we check if they used that one. Right. If you can see, they used the 20 years. But the problem, they didn't take into account the residual value. So we can comment that the correct useful life of 20 years was used. Was used in determining the depreciation. But the residual value of, remember that our residual value is supposed to be taken into account when you are determining your depreciation. Right, our residual value is 500,000. Was not taken into account. Right. Then next, we have to see if this 1.25 is correct. 1.25, remember that that is 1 year in 3 months. 2.25 is a quarter of a year. A quarter of a year is 3 months. So it's 1 year, 3 months. So let's check if there was 1.125 years at the beginning of the year. Right, this building was available for use as from 30 June 2019. Right, and our current year is ending on 31 December 2021. So the first depreciation year was supposed to end on 2020. Remember, the accumulated depreciation at the beginning of the year was supposed to end at 2020. Right, 31 December 2020. Right, from the day that it was available for use, 30 June 2020, 2019, up to 31 December 2020. That is 1 year, 6 months. 1 year, 6 months. So that is 1 year, 6 months. Right.
So
but they used 1 year, 3 months, 3 months, because they used the 30 September, the day that they took occupation. Hello, someone said something?
Mr. Eugene, when you
Yes.
calculate accumulated depreciation,
I can't
don't
hear
you calculate? Can you hear me now?
Yes.
When you calculate accumulated depreciation, don't you calculate it until the previous year before the current year?
Yes.
So isn't it supposed to be 5 months instead of the 6 months?
The current year is 2021 year. So up to 2020, 31 December, it's 6 months. 1 year, 6 months.
Oh, 2021. Okay. No, it's
yes. Fine. So from 2019, 30 June 2019 up to 31 December 2020, that's 1 year, 6 months. We will not count June because it was a 30 June. So from July to December, 6 months in 2019, then from January to December in 2020, 1 year, 6 months. So they were supposed to use 1.5 years instead of 1.25 years. So I think they calculated depreciation from 30 September, the date when they took occupation. Right. So we're saying the accumulated depreciation at the beginning of year was supposed to be provided over 1.5 years, not 1.25. It appears depreciation was provided from the date that the asset was brought into use, instead of from the date that the asset was available for use. Is that right? So accordingly, we are supposed to use the available for use, not the brought into use. Right. Then the depreciation for the year. I think the wrong thing about the depreciation for this current year is just that the wrong cost, and also the wrong, they didn't take into account residual value. We've already mentioned it. Any questions there on the buildings? There is no derecognition because we didn't sell the building, and there are no further disclosure requirements that could be done here. Right. Then we'll move on to the tractors. Remember the tractors, they said that owner-occupied equipment and tractors are accounted for in accordance with the cost model. Depreciation on the tractors is provided for in accordance with the units of production. And normally, I think from yesterday, you know that if they say units of production on vehicles, it's usually the kilometers traveled. All right. On 28 February 2020, that was last year, Veranda Limited acquired 10 plowing tractors at a cost of 1,150,000 each. The tractors were acquired to meet the increased demand of vegetables within the Southern African region. At the acquisition date, the tractors had an estimated combined useful life of 9,000 kilometers and an insignificant residual value. The tractors were available for use and brought into use on the acquisition date. During the 2021 financial year, the emergence of several young African farmers and border closures because of the COVID-19 pandemic led to a significant decrease in the demand for Veranda Limited vegetables in Botswana, Malawi, and Zambia. Consequently, Veranda Limited decided to sell 5 of its plowing tractors to generate additional cash flow for the business. Veranda Limited sold each tractor for 680,000 on 31 December 2021. That is at the end of the year. Management determined that the recoverable amount of each tractor was greater than its carrying amount for the year ended 31 December 2021. Right. So if the recoverable amount is greater than the carrying amount, they are just trying to tell you that there is no impairment. There is no impairment. The tractors clocked a combined distance of 1,200 kilometers in 2020 and 1,500 kilometers in the 2021 financial year. The kilometers were incurred evenly throughout the year by all the tractors. Right. Number one, the cost. These are 10, and they were bought at 1,150 each. Is that right? Of which the cost is 11.5 here. 1,150 times 10, it's 11.5 million. So we can say the cost was correctly calculated. Initial measurements. The initial cost of the 10 tractors was correctly calculated. Right. or determined. The next thing is the accumulated depreciation at the beginning of the year. 1,12778, this one. We have to find out how did they calculate it. They said the 11.5, then multiplied by 1.2, then divided by 9 million. Right, if you can see, they used the correct useful life of 9,000 kilometers. And they used the correct kilometers traveled, the 1,200 in 2020. That was very correct. But the wrong thing was to include the turnover 12. Remember what I told you yesterday, that when you are determining depreciation using the units of production, we don't take into account the number of months. We don't take into account the number of months. We are only interested in the usage. So the issue of the number of months falls away because depreciation is being provided according to usage. So we're saying subsequent measurements we can say although accumulated depreciation at the beginning of the year correctly used the useful life of 9,000 kilometers and the kilometers traveled of 1,200 kilometers. It was wrong because it took into account the months for which the tractors were available for use. The units of production methods of providing for depreciation. Does not take into account the period which the asset was available for use. It just uses their usage during the period. So when you're using even if you buy an asset with 1 month to go to year end, you don't take into account the number of months when we are using this method. Any questions? Right, then we go to the depreciation for the year. Next, the depreciation for the year. Okay, let's look at the disposal. 680 times 5. That's the recognition that you were asking about. They used the selling price. Firanda sold each tractor for 680.5. Okay. Before I go to the recognition, let me just also look at the depreciation for this year. 1.5 over 9,000. Depreciation for the year was correct because they used 1.5 in 9,000. That was very correct. So the depreciation for the current year, was calculated correctly. Right. Recognition. The tractors that were sold were wrongly derecognized. Selling price. All assets derecognized should be derecognized at the carrying amount, that is cost less accumulated depreciation. On the date of derecognition. No, they just used one policy. They didn't use a two policies there, but they just misapplied the demands only. So you can't say that they necessarily use the two policies. So it wouldn't come out right. Right. So here was saying, my friends, they used this selling price. When you are derecognizing an asset, you derecognize it at cost less accumulated depreciation. We don't record the selling prices. I said yesterday in our PPE. We don't record the selling price or
Mr.
assets
Eugene.
sold. Yes, sir.
Sorry, Mr. Eugene, can I take you back for my reasoning of the question, why I'm saying that they use two policies? When I look at it, for me, it's like they use the diminishing balance method and also the units product method. The reason why I'm asking is because on the requirement, it says that support all incorrect aspects of the accounting treatment and disclosure in the note. And it also says that we need to correct the accounting treatment or disclosure requirement.
So what are you saying? So what were you saying?
On how are we supporting all incorrect aspects of the accounting treatment and disclosure requirements identified?
Remember, you mean how are we treating? What do you mean there? I need to understand your question.
I'm asking because it says support all incorrect aspects of the accounting treatment and disclosure requirements identified in the note with the correct accounting treatment of disclosure requirement.
That's what I'm saying. Remember that for each, I'm saying here we said all assets, this is the wrong thing. Then here, this is what they were supposed to do. For example.
Oh, okay, I was asking on the subsequent measurement, but it's okay.
Here, remember that I said they were not supposed to take into account the period for which the asset was available for use. They were just supposed to use the usage only. So that covers the incorrect treatment and how they were supposed to do it.
Okay, thanks.
Right. Any other questions?
Mr. Eugene,
Yes, my boss.
for the subsequent measurement, will it also be okay to say the units of production method is not apportioned?
That is very correct. That's another way of saying what I've said. What I've said is very, very correct what you are saying.
All right.
Yes. So that's that's another nice way of writing what I wrote there, and also very correct. Right. Can I move on?
Yes, you can.
Right. Then we deal with the equipment. Right, at your own time, my friends, instead of here, I just wanted to show you how to answer if it's a theory question, because sometimes these days they just answer, also ask the theory question. Right, if you at your own time, for just practice sake, you can just try to do the question and do the PPE, assuming that they'd asked you to do the PPE. Then you see how to do that PPE. I think we have done several that you now know how to do the PPE. Right, the equipment. The cost here is 869627. And we know that the policy of the equipment they are using the straight line. Right. Now let's go and read what they have on the equipment. On 1 March 2020, that was last year, Veranda Limited acquired modern conveyor equipment to assist with the packaging process in the packhouse. The equipment was imported from Kigali in Rwanda at a cost price of RWF 52 million and one. On 1 March 2020, the equipment was shipped free on board and Veranda Limited paid shipping costs of 70,000 on the same day. The conveyor equipment arrived in South Africa on 15 March 2020. An additional 50,000 was required to have the conveyor equipment installed. Installation was completed and paid for on 31 March 2020. The conveyor equipment was available for use as intended by management and brought into use on 1 April 2020. Right. I think up to now I can be able to deal with the cost. Initial measurement. Right. When you acquire an asset in Forex, you convert the cost price using the spot rate on the transaction date. Right. Now, if it's a free on board sale, the transaction date depends on the nature of the sale. Free on board CIF, we use the shipping date because the date that the shipping happens, that's the date that the risks and rewards pass to the customer. That's the transaction date. So the shipping date here was 1 March 2020. So when we convert this amount, we're supposed to use the spot rate on 1 March 2020, which is 70.41. Right. So we use but they can, as I said, it depends on the type of sale that if it's a COD, a cash on delivery, the transaction date is the date that the asset arrives in the hands of the customer. Right, but this one is a freight, like free on board, FOB sale. If it's an FOB sale, the risks they transfer on the date of shipment. So the shipment happened on 1 March. So they were supposed to translate this at 70.41. So let's see. And also another thing on the cost, they should also include the shipping cost. They should also include the 50,000 installation cost, their direct cost of acquiring the asset. So we have to check if they were included in the cost, all those things. Right, the cost here, the 869,627. What they did to get it, they said 749,627 plus 70 plus 50. So number one, they correctly added the shipping and the what? And the installation cost. Is that right? So we can say, remember they said that you should also talk about the correct things. The shipping and installation costs were correctly included in cost of the asset. Now let's go and check the translation of the original purchase price. Right, they divided by 70.57 here, which is the average rate instead of the spot rate on transaction date, which was 1 March 2020. Right. So we can say the original purchase price was wrongly translated
Mr. Eugene,
yes.
just a quick one. On the first sentence there, wouldn't it be much more clearer if you said the shipping and installation costs were correctly included?
Yeah, I actually left out. That's what I said, but unfortunately I left out that way. Thank you so much.
Oh, okay.
Thank you so much, sir. Right. So the was wrongly translated using the average exchange rate instead of using the spot rate on transaction dates.
Sorry, can I ask something?
Yes.
On the calculation of the cost, where did they get that 749,627? I can't see it here.
No, it's not in the question. They were calculating. It
So
was
we just,
calculated, and they showed the calculation here. Their calculation, that's what we're commenting on.
oh, so we just assume it's correct like that.
No. We're not assuming it's correct. Here it is. They said 9.1. Here it is. That's what I'm commenting on. That they used this wrong rate. That's what we're doing exactly right now. That they used the wrong rate of 17.57 instead of using the what? This is the 749 that you're talking about.
Yes.
So that's what I'm commenting on, that they used the wrong rate of 70.57, which is the average rate instead of the 70.41, the exchange rate on the transaction date.
Okay, but you are saying it was correctly calculated.
No. I didn't say it was correctly here. I said the shipping and purchasing costs were correctly included. The shipping and installation costs were correctly included in cost. I'm not talking about the purchase price.
Okay.
Here now, if you see this part, the original purchase price was wrongly translated.
Okay.
Using the average exchange rate instead of using the spot rate on transaction date. Is that right?
Also, yes, I get it. I think I didn't read
Then,
correctly.
Okay, in an FOB sale, the transaction date is the shipping date, which is 1 March 2020. Is that right? So that's the part that you are talking about, my sister. There. So we're saying their calculation, the adding of the shipping and installation is correct, but the original purchase price, the translation is wrong.
Okay, thanks. I get it.
So at the end of the day, their cost is wrong there. Right. Then we look at subsequent measurement. The conveyor was available for use on 1 April 2020. So our accumulated depreciation at the beginning of the year should be from April to December, which is 9 months. We have to go and check and determine that the conveyor equipment had an estimated useful life of 10 years and a residual value of what? 50,000. Right. So if we can go and check if they used the correct, so you can see that they were using the correct 50,000 in 10 years and the 9 months. So everything was correct. The residual value, the useful life, the 9 months. Is that right? But the wrong thing is because their calculations will now be wrong because of the what? the wrong cost. Right. So what we can comment is that the calculation of accumulated depreciation at the beginning of year and depreciation for the year used the following correct parameters. Useful life of 10 years. Residual value of 50,000. Accumulated depreciation at beginning of year over 9 months. That is 1 April 2020. Was it 1 April 2020? Yes. Date available for use. To 31 December 2020. Previous year's year end. Right. However, the depreciation calculations will still be wrong. Because the cost used was wrong. Is that right? So at the end of the day, it will still be wrong because the cost used was wrong. Right. I'm seeing something here. Let's go and see what is happening here. I'm seeing there's something else. They said that on 31 December 20, the directors of Veranda estimated the remaining useful life of conveyor equipment to 6 years. Oh, so I think let's say let us qualify this and remove the depreciation for the year. Right, so we say that one is correct, but now for this year now, there's a change in accounting estimate. The remaining useful life to be 6 years and the residual value 25,000. But they said that per the intended bookkeeper, the changes in estimated useful life and residual value of the equipment was not considered as it occurred on 31 December and will only affect future periods. Right. So we're saying, and I didn't put a heading here. Can I please put a heading here? Because that's no longer initial measurement. Subsequent measurements. Right. The depreciation for the wrong year was wrong as it did not take into account the changes in the useful life and the residual value. And this should have resulted in the following. Number one, to allow for prospective application as required by IAS 8. Depreciation for the year should have been based on carrying amount at the beginning of year. And not at cost. Remember what I said yesterday, that if there's a change in the useful life, in the residual value, in the depreciation method, you now provide your depreciation according to the you now apply it on the carrying amount at the beginning of the year. You no longer have to use the original cost price to allow for prospective application. Right. Then another thing, the change will be regarded as if it happened from the beginning of the year. The remaining useful life of 7 years should be used instead of the original useful life. Where am I getting my 7 years? Here, my friends, they said that they determined that the useful life was now on 31 December. They re-estimated the remaining useful life to be 6 years. Right? If on 31 December it's 6 years, that means from the beginning of the year it was 7. So you should be very careful when a re-estimation of the useful life is done at the end of the year. When you calculate the depreciation for this year, you have to add 1 year. Because we remember that I told you that the standard is not explicit, but the UNISA approach for your module always you take as if the change happened from the beginning of the year. So we have to add 1 year to make them 7. Right. And the residual value, they will now supposed to use the 25,000 instead of the 50,000. Right. So say the new residual value of 25,000 should be used instead of the old one of 50,000. Right. So this is what they were supposed to do. Any questions there? Right. So with this, I was just trying to show you that you can be asked instead of just asking you. Sometimes they just give you, then you won't get disturbed to see what is this. You will simply have to comment. Normally, when they ask you to do critical analysis, you have to comment on both things that are correct and both and that are wrong. Unless if there are some questions whereby they specify that only a comment on wrong things, then in that case you only deal with the wrong items. But if it's an open question, normally we expect you to when they say do a critical analysis, we expect you to comment on both the correct and the wrong. And you should be very careful. In some questions, they can say provide the correct calculation. So that means instead of just commenting on like what we're doing, then you also be doing the calculations to show, oh, the depreciation should have been this if it had been done correctly. But in some like this one, they can say no calculations. You are just commenting and writing the principle and concepts that are supposed to be written. Any questions? Okay, if you don't have any questions, thank you very much. Then you can enjoy your weekend, and I wish you all the best when you write. Plus, my friends, please don't forget, I was just concentrating on PPE and fair value measurement and investment property, because these are the recent topics that we've been doing. But actually, remember that this test, most of the tests going forward, they can test anything also from whatever we have done. Although I foresee most of the things to be dealing with PPE. But you should be able to revise everything that as we go. Because any other forthcoming thing can also have a concept from what you have done, because the assumption is you have already done it. So I wish you all the best and God bless you richly. And I think there are guys who sent something to me, questions. I'm very sorry. My yesterday was very, very hectic. Actually, it was up too late. I've not abandoned you. I'm going to look at that when I finish my classes today. Very sorry about that. I actually saw today when I went on my WhatsApp that there were some messages. So I deliberately did not open them, because if I open them, then I'll forget about them. So I'm going to deal with them after classes. Very sorry about that, but I will deal with you guys. Thank you so much and God bless you richly. Have a blessed day. I will send the recording very soon. But for those with questions, I will do them later. Those who, when you get time, you please just try to do the PPE from what we did. Okay, thank you so much and God bless you richly. Have a blessed weekend.